The goal for Susan and I this evening is to give some financial perspectives and financial considerations regarding some of the early stage companies or developing technology, developing a company around that, and then what are the financial considerations that you need to be aware of and think about in this process as you're trying to develop whatever product, company, idea, and move that forward so you can be successful. To give you a little bit more detail on my background, equity research analyst, write buy, sell, hold recommendations on stocks. You sit down with the management team, the CEO, CFO of the particular companies that you're covering. These are public companies generally, going through their financials, looking very detailed at the strategy, the products, and then trying to come up with a forecast of here's how the company is going to do in the future, and then writing that up with recommendations for Wall Street and investors to then base their decisions off of. So did that for a long time. After leaving that, went to GKV Capital Management. We manage money for individual investors. Some of that can be in private companies. The bulk of it's in public equity. But always doing a thorough analysis of the companies that we're investing in. So hopefully able to give you the investor's perspective, having done a lot of analysis from the financial perspective, from the product perspective, and sitting down and evaluating management and making those investment decisions. So that's what trying to bring to the table here today. With that, I'm going to jump into talking a little bit about economics, broadly speaking, U.S. economics, how that affects investors in this country, the world over, what they're looking at and looking for. So hopefully you get an idea of the mindset that people are looking for when they're making investment decisions. Fundamentals in the U.S. right now, they're very strong. GDP is just about 4%. That's what it's forecast to be this year. Inflation is very low. The CPI numbers came out today for the month of February. They're up 0.1%. Interest rates have been going up. That affects the economic environment somewhat, but because of tame inflation, we don't think they'll go up very much. Equity valuations by historical standards are relatively low. The best benchmark for that is looking at the price to earnings ratio, which is about 15 times 2005 estimated earnings, or actually that's 2006 estimated earnings. And the average dividend yield for stocks is about 1.6%. All those metrics from a historical standpoint are right in the ballpark of where you want to be. And they're not terribly aggressive. From an investor standpoint, goal is to make money. Looking at, say, the Dow Industrials over a 10-year period, made 7.2%. That's the index. The NASDAQ index, 7.7%. Venture capital, this is interesting. This comes from the Venture Capital Association, so it's a little bit of a black box, and you have to, I can't drill into the numbers and figure out where they got this exactly. But over a 10-year period, claim it to be about 27%. Now, the important thing to consider from a venture capital standpoint is the returns on venture capital tend to be very skewed. Either you do really, really well, or you have very little to show for your investment. You invest in 10 companies, maybe one of them does really well. 5 of them go under, and maybe 4 of them get sold. Maybe they get sold by Susan at a little bit of a profit. And you come out with your 27% if you blend it. The point here is that venture capital is a great way to make money. And the venture capitalists don't have a difficult time, the successful ones, raising funds to then put into technology companies. And that's typically where most of the dollars are going. Technology, whether it's biotech or internet or semiconductors, it's technology. Here's some fixed income comparisons, just for comparison. So what are investors looking for? Who's running the company? Management's going to be the most important thing. And we can in Q&A get into, and I think Susan's going to touch on this a little bit, what some of those important characteristics are for management. But is the company going to be able to execute? When I sit down with a company and trying to make an assessment as to, is this something that's going to be successful? The first decision I'm making is this a management team or some people in place, or at least the very basic foundation for success? The product, obviously, that's important. The market, how big is the opportunity? Competition. One thing that tends to get overlooked by a lot of entrepreneurs are the numbers. It is important to, going through the exercise of putting together your business plan. The numbers are really pretty critical because at the end of the day, that's how investors are going to look at the business. If they like the product, how much is it going to cost to make? How much is it going to cost to market? How are you going to market it? And what are the potential profit margins long term? And I'll show you some things here in a second as to why those are so important. What are the hot investment sectors? I'm not sure this slide really matters. It's if you have a good product, if you have a compelling idea, and you have the management team that's able to execute that on that idea, that's going to be everything. Products, not technology, drive revenue. Ultimately, say I've got this great new technology. I would stipulate that Microsoft never had the best technology. There are a lot of companies never had the best technology, but they had some fantastic marketing, and they were able to position themselves in such a way to take advantage of that. Valuation of a company, what it's worth. This is a little important because you have, well, I'll get into this in a minute, but for private companies, from an investor standpoint, they're interested in a profit. And the way they're going to make profit is liquidity. The problem with private company investments is they're illiquid. I can't sell my shares very easily. I have to find someone else either to step in there and take my place, if I can, or I just have to sit and wait until the company either goes public, or there's some M&A activity, or the company is making so much money that they're able, in dividends back to the investors, even if it's private, be able to pay me back. And as an investor, I am interested in valuation. How do you maximize your valuation as a company? If I think you have great prospects, if I think it's growing really fast, and I think you're going to be able to make a lot of money, that's what I'm looking for. If you're making a product that I think is going to be really, really successful, but your margins are going to be tiny, competition's going to be fierce, you're going to have to be really, really big for me to ever make any money off of that. This is a little bit of an eye chart. The number of companies here on the left, recognize most of them. I guess I spelled a few out for you. Google, Yahoo. Just for fun, compare Time Warner. They're all media companies. You look at the prices that these things are trading at, not the stock price, but the price to earnings. How much money do they make? Where's the stock trading relative to that? Google doesn't make money yet. People are banking on the fact that they're going to in the future, and that their business model is similar enough to Yahoo that it will be like Yahoo. Yahoo's trading at a valuation from an earnings standpoint double that of a Time Warner at 50 times. Time Warner at 27 times. You look at the revenue. Time Warner has $43 billion in revenue. The market capitalization is not quite double. It's a little less than double. Because of Yahoo's level of profitability, because of the rapid growth, people are willing to assign a much greater valuation to a Yahoo than a Time Warner. That's important for anyone doing, say, a media internet startup company, because Yahoo, in order to support that valuation, in order to stay way above Time Warner and other media companies out there, they have to maintain that growth. As the company gets bigger and bigger, how are they going to maintain that growth? It's very difficult. They've got to find new businesses. They've got to get into wireless. They've got to get into other areas that will continue to drive that growth. Just to come back for a second, I mean, take some other businesses like the INFY down halfway there, right there, and IBM. That's Infosys. They do professional consulting, computer consulting, basically, but it's run out of India. As a result, they charge, they're able to do things far more efficiently than, say, an IBM. And they have almost 3 times the valuation than an IBM does. That's driven off of the level of profitability and the growth. If you can find a way to, say, make a better mousetrap, but do it much more profitably, you'll benefit from that. Here's another comparison, Amazon and Walmart. Here's a case where I'm not sure that Amazon would justify such a big valuation relative to Walmart. At the end of the day, this net margin down here, how profitable are you, is almost the same between both companies. Amazon, when I sat down with the original CFO of Amazon and they were on the roadshow during their IPO, she said we're going to be able to do 14% net margin. We're going to drive huge efficiencies out of not having to have brick and mortar buildings. We're going to have all this be web-based, and it's going to be a whole lot cheaper. And because of that, we're going to be able to sell a lot more product at a cheaper price and still make more money. The reality is, whether you're Walmart or Amazon, selling it over the web or selling in bricks and mortar, it's almost the same valuation, same level of profitability. As a result, I think you'll see Amazon, for instance, and Walmart come closer to parity over time, unless Amazon can find new ways to innovate and drive valuation. Here's another example, Infosys and IBM. The difference here, net margin 26%, IBM 8.7%. That's justified. Now, as, say, workers in India are going to have to be paid more as you have more and more competition for IT services, that's going to change. Their level of profitability will come down, and that will affect the company. Point of all this is, as you're evaluating your business and looking at your market, it's also important to look at what can be the financials of this company. What are going to be the levels of profitability? If you're selling software, software is a beautiful business because once I create the software, I'm selling CDs. I'm selling bits. I don't have to invest capital spending in a processing plant or semiconductor capital equipment if I'm making wafers. I'm selling bits. That's 96%. Adobe has 96% gross margins. It's a hugely profitable business. But there are low barriers to entry, a lot of competition. It can be a difficult market. Here's the liquidity. You look at 96. This is the number of IPOs that were done from venture-backed companies back in 96. You look at 95. Most companies nowadays, early stage, either it's taken them a lot longer to get to public, and so far fewer of them are going public, or they're selling themselves. You look, here's the M&A numbers over the last several years, which has been pretty consistent. A lot more sales to the likes of Yahoo, Google, Cisco, Microsoft, and other companies trying to keep up that growth rate. Here's some of the numbers in specific areas: internet, semiconductors, communications media, computer software, computer hardware, biotech. Again, this is all just venture-backed companies and the number of deals in each of those sectors. And here's those same numbers for M&A activity. This is all in 2005, last year. One thing that's interesting, again, when I was talking about from an investor perspective, a lot of these companies aren't going to work out. A few do. You look at the deals, deal value less than the entire venture investment. This was in 2005. Only 48, well, almost half lost money on their investment, even after the company was sold. Okay, so the company didn't go under, it wasn't folded completely, it was sold. Venture capitalists still lost money on it. But here's the ones that really make up for that. 10%, 18%, almost a fifth. They made 10x their original investment. Again, from your perspective, what's that investor looking for? They know that half these things aren't going to work out. They're going to lose money on those. They're looking for the couple that are going to do really well. Here's a couple of more venture capital statistics. Almost 3,000 investments in 2005. 3,000 investments, there were only a few hundred IPOs done in the year, and M&A, there's only several hundred M&A deals. So 3,000 get funded, only 20% actually ever see liquidity. I'm going to leave lots of time for Q&A. I don't want to take up any more time, so we're going to let Susan take over from here.
Okay, thank you. So when Greg and I talked about how we're going to split this up, Greg took the big picture and did a great job, and I decided to focus on the beginning and the littler picture. So my focus is going to be on startups and early stage firms, and what are the considerations for them. And if you're a startup or an early stage firm, there's two things to really worry about with finance. One is raising capital, and the second is operating the firm. How do you manage your financials and your financial system when you're operating? So I'm going to start with raising capital. And capital sources, most of you are well aware of these. The top 4 and 5, actually, are all available to early stage firms. I'm going to focus on the top 3, friends and family, angels, and venture capitalists. Government grants are a great source of early funding. Asset-based lenders are later stage firms. When you have revenues, you've got profits, you've got assets as collateral. So how do most firms get their very first money? 95% of company startups are really backed by the savings of the individuals and personal loans, the friends and family. Now, friends and family, is it good or is it bad? Well, it's risky for the friends and family that are lending you the money, and it's stressful for the people that are taking the money, because you feel a real obligation or responsibility to them. And the default rate on a personal loan, friends and family, is 14 times that of a bank loan, so it is risky. So tips, because many of you will end up taking friends and family money as you start your firm. One is to be sure and document the loan terms. Don't do handshake deals. Why? Well, first of all, other investors are going to come in. Venture capitalists are going to come in. And you're going to have all these handshake deals that aren't documented. That's going to be a big warning signal to them that you're not professional, you're not handling things as well as you should. And the second is, if it's not in writing and signed, the relationship with the friend and family can be ruined. It's better to just get it all in writing. It's a clear agreement. If there's any misunderstandings, you go back to the agreement. The second thing to remember is to use a fair interest rate. Because I know lots of times, like, a father will say, oh, you don't have to pay me interest. You need to pay him interest. You need to do a fair interest rate. If for no other reason, the second bullet, the IRS will apply a fair interest rate to it. But the first one is, later on, when suddenly you can't make payments or you need an extension, the people lending you the money will feel much more comfortable about it if they feel like you've been treating them fair all along. So don't take the low interest rate. Give them a fair market rate of interest. Third is avoid balloon payments. Now, a balloon payment is when someone will lend you money and say, you don't have to pay me anything, and at the end of 2 years, you can pay me the whole thing back. You want to avoid those. They're really risky. Because especially as a young company and an emerging company, to try and amass that amount of cash to pay it all off at once is almost impossible. So avoid those balloon payments. And also, remember the tax benefits, and that's another reason to formalize the loan. If, and we don't want it to be the case, but if there's a case where you've got a loan from friends and family and you can't repay it, they can write that off as a bad debt expense on their taxes. So they haven't totally lost their money, they actually get some credit for that. And my last point is, enjoy the flexibility of friends and family. Yeah, it's stressful and it can be risky, but it's also really flexible because they are friends and families. You can go to them and say, I need an extension. I need to skip a payment. And you've got much more flexibility than you do in other situations. So that's how most companies get their very first money. Second place they go are angel investors. And in fact, in 2004, of 3,000 new firms were funded by VCs, 48,000 got their startup capital from angel investors. Now, people say, well, why don't you just go right to a VC? Why use an angel? Well, look at this. A lot of people use angels. Google started out with $100,000 of angel money. Amazon, Apple, Kinko's, Starbucks, they all started with angel money. Some of the current big rising stars were angel money. So don't overlook angel money. It's a good source of capital. The third source you can look at is finally venture capital is returning back to early stage. In the dot-com era and the internet era, VCs, a lot of them were investing in young companies. When that all fell apart, there was a more conservative bend and more of a movement towards investing in more mature companies that are further along, they've got revenues, it was perceived as not as risky. So why are they coming back to early stage? Well, one is they're starting to forget that bad experience with the dot-com. The other is that it's a crowded field in the later stage companies. There's all these investors and VCs and angels all going after the same few later stage deals. And it's harder to find those real winning deals. The returns actually in early stage are as good, or I'll show you better, than in the later stage deals. And there's something that we call overhang, which I'll explain. So this is overhang. So what does this show us? The red is the commitments. So the venture capitalists go out and they get money. They raise money, they get committed money. The blue is what they invest. So what's happened, if you can see, is they've got more money committed right now, and this line is the overhang, what's left over. So there's money out there that they need to spend. And they can't all just be fighting over the same later stage deals. They're going after early stage. So that's an advantage for you. Other thing I mentioned was the return. Look at this. Early stage venture capital return, 5 years, 58.3%. 20 years, 19.9. They took all the funds formed since 1969 through 2003 to get this. Compare that to later stage, 3.5 and 13.8. So a bit of that movement towards later stage was maybe a bit of a fallacy. So 5 tips when you're out there trying to raise your capital, early stage capital. One is be very prepared. Focus. The whole focus should be on why your business is going to make money for your investors. And by be prepared, financial projections, cash flow, market competition, how you're going to execute, you're going to get drilled on that. I want you, you need to look at it from every angle and have all the answers and have thought about it or have said, we've looked at it. When they mention a competitor, you have to be able to say, yes, we looked at them and this is how they're different. So be very prepared. The second tip is to conserve capital. In the 1990s, there was this big thing about burn rate, and there still is. And in theory, the burn rate of a startup company is how much money you're burning through or using on a monthly basis to run. So if it's costing you $50,000 a month to pay your salaries and your rent and your overhead, that's your burn rate. But in the 1990s, there was this joke going around because money was so easy to raise that it was like, we can burn this money and get some more. So that's over now. Now the emphasis is really on conserving capital and getting as far along as you can without raising more money and being very frugal. There was also a joke that the biggest kiss of death when you walk into a new company is to see the expensive office furniture and stuff. You want to see someone who's really being frugal with their money. Be committed. You've got to be committed. You can't expect someone else to be committed if you're not committed. Working without a salary. You put your own money on the line. Show your own commitment. You have to have an outstanding management team. Why? Because that's a way to reduce risk for investors. The second point, which is very true, is that a great team can take a mediocre or poor idea and still be successful. But without the right team, even the greatest idea may never get off the ground. So what do we mean by management team? Not too long ago, I had a venture capitalist look back at his history of venture investing, which was many, many years. And he looked at 32 of the companies that his firm invested in as startups, which ended up very successful. So 32 success stories from startup to huge success. Of those, only 2 did not have an experienced management team. So that really means a lot in my mind. And then you ask, what do you mean by experienced? It's people that are either experienced with starting companies and have done it before, or they come from a lot of corporate experience in that industry, in that arena. So that's an important thing, management, management, management. For instance, how could you have missed on this one? It's hard to believe, isn't it? See, and I guess one of the reasons I threw this in is to show that, yeah, it's easy for me to tell you need all experienced people, but then look at this. You know. The fifth tip is to be patient and persevere, because there's not as many people out raising capital now, but there's not as many people willingly lending capital right now. So it might take a year, it might take 2 years. I've seen companies out banging on doors for 3 years. It's a numbers game. Be persistent. Listen to what people say to you, and when they don't invest, ask why, and adjust. So let's say you're talking to investors. How do they screen opportunities? When we get business plans and ideas, how do we screen them? We don't analyze each one in depth. We don't do due diligence in depth. We ask ourselves some pretty basic questions. Bottom line, is it a good idea? How do I know it's a good idea? Part of it, I just get this feeling that this is a great idea. But part of it is the best ideas are ones that solve a problem. There's some problem out there, and this is the perfect solution. Or there's some unfulfilled demand that people are asking and asking for this, and now here's the answer. The more difficult ones are the ones that it's a great technology or great idea, but it doesn't have a home. The laser is an example of that. The laser was developed long before they knew what to do with it. And it's evolved into a very important tool in many different industries, you know, healthcare and on and on and on, defense. But it took it a long time. So from an investor's perspective, you want something that's solving a problem. Is there a large market potential? It's great if it's solving a problem, but not if there's only, you know, a handful of people that want it. How big is the market? And we always ask ourselves, is it fundable? So what I kind of feel is I think to myself, okay, if it was my job to go out and raise money for this company, do I think I could raise money? Because if I can't raise money for it, why would I be investing? You know, do I feel like this is a deal that other people would be interested in? Management. I look at the management. What expertise do they have? Is it a well-rounded group? And a big one is barriers to entry. Because no matter how great the idea is and how good the management team may be, what's going to stop the next person that hears about it from doing the same thing? There's got to be something that protects you, gives you some protection. And you know, one dilemma that we're always facing is, what do you do with these large, obvious opportunities? It's a huge market, great opportunity. You know, if there's natural barriers to entry that are going to keep other people from coming in, then it's a good opportunity. But you know, if it's going to be hard to defend your position, then it's kind of less clear-cut. For instance, when search engines first started, there were many startup search engine companies, and I don't know the number, but hundreds, at least 100. Now it's down to just a handful, and it's going to be down to just 2. Do you want to be one of those that doesn't make it? So one thing I look at is, you know, don't just look at a good team in a big market. You've got to realize that everyone's going to come flooding to that. There's going to be crowding in that market. So then figure out, if there's not natural barriers to entry, what can you do to protect yourself, to make it proprietary? Is it patents? You know, is it licensing agreements? There's something that's going to make you be able to defend your position. And sometimes, you know, investors, we just have to have the courage to pass on a hot sector, because we don't want to get out there fighting with 800 other people when there's only going to be 2 winners. Once it passes that initial screening, then we start doing an in-depth analysis. Key are financial projections and cash flow. Why? Because we invest to make a return. It's all based on what kind of return we're going to get. You know, of course, driving that is, what's the competition and what's your advantage? Market, what stage the market is in. Is it mature? Is it dominated by a few big players? how appealing it is. Proprietary protections, very important. And proprietary protection could even be things like branding. If you've got your name out there as the search engine or whatever. And then the other question is, can you produce this and sell it at a profit? Maybe it's a great idea with a huge market, but you can't do it profitably. And this is real in-depth. It's a lot of due diligence, a lot of meetings, a lot of questions, a lot of going through your plans. Then, once you've passed that, the next step is, okay, so, and in that process, we've determined how much money you need. Because it comes out of your cash flow. Your cash flow shows how much you're going to be negative, when you're going to be negative, how much you need. So we've determined how much you need, but the next question is valuation. How much do we get in terms of equity for that money? It's driven by our own estimates. So we take your cash flows, yours, and we tweak them. We ask you questions, we change assumptions, we come up with our own vision of what we think the company is going to be worth in 4 or 6 years. Then we say, well, what kind of return do we need? And we need about a 30% return. That's, real seat of the pants for venture investing. And we back into how much of your company we need to get as an equity position in order to get that return. And I've got a chart coming up I'll show you. I just wanted to mention something quick because people throw around these terms pre-money and post-money, and they're not daunting at all. Pre-money is, I look at your company, I think, boy, this company is worth $5 million. And you want $2 million. So I give you $2 million. So now you're the same $5 million company, but you have $2 million of cash in the bank, so you're worth $7 million. That's all it is. Pre-money is what you're worth before you raise the money. Post-money is how much you're worth once you've raised the money. Okay, so this is what I meant. How do we back into the percentage that we need to get? So I'm based on that I want a 30% return. And let's see if I can do this. Yeah, I can. Okay, so this means if I'm going to invest $2 million, and I think that you're going to be worth $40 million at the end of 6 years, then I get 24% equity. If you're asking for $6 million, and my estimates show that you're going to be worth $80 million at the end of 6 years, then I need a 36% equity position. It's all driven by the numbers. So if you're at a stage where you're negotiating with a venture capitalist and they're saying, well, we need 20% equity, and you're saying, well, let's make it 10, you're going to have to give them a compelling story why the projections are different than what they're assuming. Because it's not just negotiating 20-10, we'll split the difference. You've got to show them why they're still going to get their return. Financial concerns beyond raising capital. So you're starting up this company, you're trying to run a small company, you're growing a small company. Number one financial concern is keep as many costs as possible variable. Don't get salaried people up front. Don't get into long-term agreements. Keep your costs variable. Control your capital expenditures. Don't go out and buy big pieces of equipment initially. Figure out ways you can, get things done without making big capital expenditures. The third point is key. You need a good accounting system almost from day one. A software system. It doesn't have to be expensive. There's Peachtree, there's QuickBooks for startups, but you need to have a good accounting system. You need to have financial management, managing your money from the beginning. You have to have good projections. So you did the projections to raise the capital. It doesn't stop there. You're constantly changing them, updating them, adding to them, comparing projected versus actual, tweaking them, and your cash flow is what drives it's your radar. It lets you know where you are in terms of cash. Because you need to plan far in advance for capital raising. It might take you a year. You cannot find out that in a month and a half, you're out of money. You have to have foreseen that and been planning for it. And how can you do that? You can only do that with a good cash flow analysis. The other tip I have is to outsource as much as possible. Why? Well, first of all, you're going to get higher quality. If you're a small company and you're cash constrained, you're not going to attract top quality experienced people for full-time jobs. You can't afford them. You know, this way, if you outsource, you can get quality. The second piece is by outsourcing, you keep your costs variable. You're hiring someone else to do defined tasks. Things get tough, you just say, thank you, we're not going to use you for a while. And it also enables you to stay focused. You're focused on your product, your market, your goal, and by outsourcing extraneous pieces, you can stay focused. So how do you know what to outsource? Number one point is don't outsource anything that's critical to your firm. You want to keep the knowledge, the brain power, anything that's critical to your firm, you keep internal. So you outsource things. I always ask myself, is it easily replaceable? So payroll's a common thing that's outsourced. So if my payroll person that I outsource it to quits, I pick up a phone book and you can find 18 other payroll processing companies. It's easily replaceable. There's nothing unique about it. That's a good thing to outsource. Same with IT, computer maintenance and repair, nothing unique. Customer service and call centers are being outsourced a lot. Marketing, certain pieces of marketing are great to outsource, but for your big strategic marketing, you want to keep that knowledge in-house. Okay, so in summary, for operations, you want to keep lean, keep costs variable, budget and use your cash flow model, and plan far ahead. And by keeping lean, nothing is more impressive to an investor than to go in and see that instead of desks, they've got card tables, and it's extremely impressive. And you walk in and you see Herman Miller chairs, and you turn around and you walk out. Okay, and then getting early stage capital, there's 3 tips I want to leave you with. Conserve your capital, because you don't know when more is coming. Get customers. A customer is king. If you have a customer, even one customer, it's so much easier to get capital. Be patient and be persistent. Tip 2, keep your day job. A lot of startups, I would say the majority of them, begin with someone with a full-time job during the day, and they work on their startup at nights and weekends. And that's a perfectly fine way to do it. And in summary, you know, good entrepreneurs get funding. People worry about the venture capital climate and everything else. If you're a good entrepreneur, you'll get funded. And you just need to do your homework and be consistent, and you'll be able to do that. So anyways, that's the end of my presentation.
So for this panel, we don't have anything real formally organized, but just wanted to maybe drill a little bit deeper into a few of the issues and the things we considered in each of our discussions. Thank you, Microsoft. One question I had you talked about in the beginning of the presentation was getting a loan from friends and family. And you get that loan. Say they don't want to do a loan structure. They'd rather take equity. Or giving you this money, I don't want it structured as a loan. I don't want to pay back. I'll take some equity in the company. There's that. And there's also, we talked about the importance of a management team, bringing in management from either that investment standpoint or bringing new people into the company, maybe in lieu of paying them a salary, you're paying them in stock or options. How would you advise people to deal with some of those questions and issues?
The reason I said loans is because when you're first starting out, your valuation is so low that you'd have to give up significant pieces of the company in terms of equity to raise small amounts of money. And I've seen fairly sad cases of entrepreneurs that have, raised $50,000 and gave up 5%. And then they raised another, $100,000 and gave up 10%. And, pretty soon they wander in for strategic advice. There's not much we can do because they've given up most of their company. They own 5%. They've given up the rest, and they need to raise $6 million. So the goal is to conserve as much of the equity as you can because you're going to need it in the future. And I've also had companies that have come to me and said, there's this wonderful marketing professional that we want to hire to be our VP of marketing, but he wants, 20% equity. And my answer to that is, not only is it strategically a problem, but professional investors won't invest if they come in and see that. And, that's, you've just handicapped yourself and put a pair of, handcuffs on by doing that. So you can give equity, but you want to really be careful with it because you're going to need it later. And it's only one pie. So that's my...
Yeah, no, I conserve it as much as possible. And you want to make the argument that, look, we give you 2% instead of that 20% as a VP of marketing, or even 1%. 2%'s in a lot of cases on the higher end. Give you 1%. 1% on a $100 million company or a $200 million company or more when it's sold. If you guys are able to do what you want to do, maybe you put in some, and we don't have to get into this for this discussion, but antedilutive clauses in there where they're able to stay close to that 1% even as other investors come into the company. It still can be a lot of money and a lot of potential. And that's the same thing that Susan was talking about earlier on selling the company to, say, venture capitalists. They're saying, well, we need 40% of the company. The goal is not to try and talk them down from the 40%. It's to convince them of how great the opportunity is and why it's so much greater in reality than what they're forecasting. And if you can show that the opportunity is 2x what they forecasted when they built their financial model of your company based on what you showed them initially, if you can go back and show them, here's where you were wrong, here's where you underestimated the opportunity, here's where you underestimated the profits or the growth rate of this company, that's how you can get that pushed out to where you're able to retain as much equity as possible. It gives you more flexibility, more control, and, well, everything.
I have a question for you. In your experience, you often have this dilemma of 1 round or 2 rounds, and when do you raise capital? And
the timing is, I'd say, difficult and different for each company and each opportunity. And it also depends a little bit on the environment. You take the mid-90s, the idea was we've got to run as hard and fast as possible. We may need to spend a lot of money to get our name out there to win this battle. I'd say that that's not a great strategy. You want to raise money when you have to, and you want to raise money as little or as rarely as possible. To go out and say initially and raise a $10 million round and give up 60% of the company when you could raise $2 million, get your product finished. I say $2 million, it could be 500,000. The numbers really don't matter. But get your product finished. Get a couple customers. Once you have those couple customers and they're using it and they're coming back and maybe buying more, now you've got something to show. Now you can show, I'm a company, I've got revenue. The valuation's totally different than what it would have been before you had a prototype, or before you were selling a product, or before you had a few name reference customers that you could show as proof of concept that this isn't just an idea, it's actually a company. Therefore, it's worth so much more than it was when it was just an idea.
okay.
You have any thoughts on that?
No, I mean, I pretty much agree. But you also have to think through that you're raising enough to get you through more than like 1 year, because it might take you a year to raise that capital. So you don't want to be doing a second round, full-time raising capital, and then you've run out and you're full-time raising capital and you've only had 2 weeks off in between.
So I guess to manage that balancing act, that's exactly right. To manage that balancing act, you want to understand where you are in the life cycle of your company, and you have to be critical of yourself. You have to be honest and say, we can realistically get this product together with this amount of capital. Give yourself a couple months, several months of breathing room. If you can get several months past the actual development of the product, for instance, that being a major benchmark, maybe you wait until after that point before, say, raising another round or going out and knocking on doors. But it does always take time, and it always takes a lot longer than you think it's going to take to raise capital. And even for the later stage companies, they always think they're going to be done at X date. I always have fun asking them, when do you think you're going to be done raising this round? It's always considerably after that it finally gets done. So you have to be careful that you don't run out of cash, because it's very hard to get loans, call them bridge loans, from institutions to make payroll for 3 months while you're trying to raise that additional capital. And if you've already built up some significant infrastructure, you haven't kept your costs real variable, as Susan pointed out earlier, you have to make certain commitments. You run out of money, then you're stuck. There's not much you can do. Do you want to open it for Q&A in general?
I have one question for you, though. You just threw out the term bridge loan, and people hear mezzanine loans, and I would can you elaborate on that?
Okay, a bridge loan is a bridge to your next financing. So if you're burning $10,000 a month is your burn rate. That's how fast everything costs. Maybe you have no money coming in. So it's real easy. You're losing $10,000 a month. You have $50,000 in the bank. Math's not hard. You've got 5 months to go before you're at zero. If you think you have a commitment from somebody to raise $1 million, but it's going to be 6 months from now and not 5, you may need to get a loan of, say, $20,000 or $30,000 to make sure that the money coming in for investment matches up with the burn rate within the company. So that's a bridge loan, and that's burn rate. Mezzanine round is after your third, or at the very end, just before you're getting. It depends on what would you define as your mezzanine round? It's usually later stage.
It's later stage, and I think whether it's after the third or after the fourth, I don't know, and I don't know if that's even clearly defined.
Yeah, your mezzanine round is your kind of last round of financing before you were to do a public offering. Although that always gets a little funny, it's a moving target because you don't know that you're going to necessarily do a public offering, and you're not sure what's going to happen. But a mezzanine round is just a late stage round. Done, again, a venture capital round that's done very late stage.
And usually, if not in all cases, they have that vision already planned out, that we're ready to go public or to be sold, and this is our last round to get us there. And things might go wrong, and maybe they, planned, and it may change, but that's why they call it mezzanine, because it's that final round.
And ideally, at that point, the company has a clear target to when it's going to be profitable as well. Hopefully, you don't have to raise any more money. You can continue organically on your own, whether you were to go public or not. And public isn't the end-all be-all. It's the end-all be-all for venture capitalists and for the investors that want to cash out and make some money, so that they can then return it to their investors. Venture capitalists, they're just managing other people's money. It's not their own. It may act like it's their own, but it's taken from somebody else. Well, they have to give those people a return at some point. That's why they're very hung up on the IPO. That's why they're very hung up on an M&A liquidity event. You running the company, it shouldn't matter that much to you. If you can make a successful company, you can be, and there are plenty, very, very successful privately. And in a certain sense, that can benefit you significantly. You can't cash out of the company the same way as a sale, but if the company's profitable, you're spending that cash back to the shareholders, and hopefully the biggest shareholder is you.
Which actually is a point we make to people that come to us and are talking about raising capital. If your goal is to start a company and run it for 30 years, you probably don't want any of the sophisticated investors or institutional investors, because they need an exit. So with that, are we ready?
I think so.
Okay, we're ready for questions.
Hey, Greg and Susan, that was great. Thank you. And I look at the audience, and there's lots of people that are participating in our new venture competition. And I've got something you might be able to deliberate between the two of you. But what would you think, in your estimation, when you're talking to an investor, would be, if you could rank from 1 to 5, the most important things to convince an investor? Let's say, okay, technology number 1, or management number 1, market size number 1. What would you at least rank in the top 2 in terms of importance to, convince an investor to invest?
Just be easy softball questions.
Mine is product. Yeah, I think number 1 is product. Because I see cases with great technology, but they haven't defined how it's really going to work or how it's going to be used. I think, defining the product is real important.
Yeah, to be clear, there is a difference between technology and a product. And, one of in the series earlier, talking about nanotechnology and, where the winners are. Technology is a great start, but then it has to be applied. And what the product is, that is critically important. I spent a lot of time talking about management. It doesn't have to be, from an investor standpoint, looking across the table at the company that's looking to raise some funds. I don't have to look at that person and say, this person's going to be the CEO of a Fortune 500 company. That's not what's important. What does matter from a management perspective is, does this person have the capabilities to get this company to the next stage? And the next stage could be, we have a technology, we have an idea, here's the product we think we can create. We're going to start doing that, but we need some funding just to do that. Or it could be, we have a product, and now we're starting to take it to market. I'm looking for a management that has the capabilities to get that to the next stage. And as the company gets bigger and the opportunity becomes more apparent, they're going to fill in, and hopefully as a venture capitalist, as an investor, they can facilitate filling in that management team with the pieces that are missing. But yeah, after products, management team, and I think certainly there has to be a problem, there has to be a market.
Right. And proprietary position, I think, is a good one. Because you see these great ideas, but why are you going to be the one that implements it? Especially, you're out talking to people, talking to suppliers. If it's that great of an idea, why isn't everyone going to do it? So there's got to be something that's unique to what you're doing. Maybe it's 10 years of research, so it's going to be hard for someone to replicate that. Or maybe it's an exclusive agreement that you're the only one that has American Express. Whatever it is, there's some reason that, or you've got a supplier, but you've got something in place that's going to give you an edge over someone else doing the same idea. And often it's patents, could be technology.
For a startup with a valuation of, say, $2 million, can I ask you what a reasonable amount of equity for an incoming CEO who's a professional in the industry would be?
When you say $2 million, how is that derived?
Based on the discounted cash flows.
I would say, first of all, there's 2 issues, and one is, that it's vesting over time, and options, and what the options are priced at. I can tell you what I know for certain is we did a search for a CFO, to bring in a very high quality CFO in a company. It's like 5% equity. It might go up to 7, might go down to 3, but you're in that ballpark. CEO, you sometimes have to give them an added incentive, but I would shoot for other incentives like bonuses and stuff as well.
Options are important in the vesting period of the options. Obviously, you want to create something to get people to stick around as long as possible and have a real incentive to continue to be with the company. Now, someone coming in a senior management position, obviously they have an incentive and they want to get the company as big and as successful as possible because they'll benefit as well. I'd say those percentages that Susan talked about would be, that 7, maybe 10, maybe a lot less. It depends what you can get out of it. It also depends on who the current ownership of the company already lies with. How much, is it one person that has 100% of that what's valued at a $2 million company? Then maybe you have a little bit more flexibility. If you're about to raise another round, maybe it's we have to give away some equity to some outside investors, and then the CEO that's coming in gets that 7% once it's already been diluted a little bit more. There isn't a hard and fast rule, but those are some of the considerations.